This week, headlines screamed energy shock and war-driven recession fears. The market, it mostly treated it as headline risk and kept rotating. Welcome to Capital Sound's weekly wrap. I am Mandy Prince here with Patrick Callahan to break down why the tape didn't panic and what that means next.
Great to be here, Mandy. A lot to unpack, but it has been a classic week of noisy headlines and a market that is pricing in a more nuanced reality.
Let's set the table, quick snapshot, and then we slow it down. This was not a straight line week. The big indices were mixed, with leadership coming from more defensive areas and pockets of cyclicals that held up better than people expected. Tech was uneven, breadth was a bit fragile in the more speculative names, and steadier in businesses tied to essential demand. That is the shape. Patrick, does that match what you saw?
It does. The tape felt selective. The market wasn't ignoring the news, but it wasn't embracing a worst-case scenario either. That is typical in weeks where geopolitical risk is high, but the actual economic data hasn't collapsed.
Perfect. Let's slow this down and start with the biggest theme, the Iran conflict and the Strait of Hormuz headlines. Here is the takeaway first. The market treated this as a potential supply shock, not a guaranteed recession. That distinction matters.
Exactly. The key is potential. Pricing a risk premium is different from pricing a downturn. You could see that in how energy and some industrials found support, while parts of consumer and high multiple tech were more hesitant.
Walk us through the valuation lens here. If you are Patrick, the everyday investor guru, how do you frame this without getting pulled into the noise?
I go back to my 6 categories and ask, what changes and for whom? In a potential energy shock, stalwarts and slower growers with steady pricing power can preserve margins. Cyclicals and fast growers might get squeezed if input costs rise and demand softens. So I am not changing the whole portfolio. I am reviewing which earnings lines can absorb a temporary cost spike.
So the conclusion is not every business is equally exposed, even if headlines sound sweeping.
That is the practical point. We saw stories about broader economic stress, higher prices, softer orders, some layoffs. That is real for certain segments. But the economy is not a monolith. In a GART framework, the question becomes, can this business still grow at a reasonable price in a slower, costlier environment?
Can you give an example of how you do the homework without going into stock picks?
Sure. I'd look at a company's earnings history and ask, have they managed margin pressure before? If their earnings line is steady while the stock price swings, that can be a sign of resilience, not a guaranteed opportunity, just a sign of stability. Then I'd ask whether their customers have alternatives. If alternatives are scarce, they can pass along costs.
That is a useful filter. Now, this week's headlines also tied the conflict to broader disruptions: fertilizer, semiconductors, packaged goods, even cotton. Sounds like a domino effect narrative. What is your pushback?
I'd separate first-order effects from second-order effects. First order is energy and shipping. Second order is cost pass-through in other industries. The market seems to be discounting the first-order effects as likely, and the second-order effects as possible, but not certain. That is why we saw selective rotation, not a full risk-off stampede.
Here is where I want to press you. If people hear closing the Strait of Hormuz, they think everything breaks. Why doesn't the market do that in real time?
Because markets are forward-looking, but they're also probability-weighted. The worst-case scenario is one possibility. The base case can still be disruption without collapse. Investors are asking, will this be a short-term shock or an extended supply crunch? And they're waiting for confirmation, not taking the nuclear option.
So it becomes about durability. If the energy shock persists, the probability set changes.
Right. Duration is the differentiator. A week or two of elevated stress is manageable. A sustained issue forces companies to reset guidance, and then you see a bigger repricing. We're not there yet.
That is a clean way to frame it. Let's pivot to the second deep dive, which is related but distinct: the idea of an energy-driven slowdown and the way that played into certain parts of the market, including those softer reads on employment and orders.
Here's the takeaway. The growth scare narrative is real, but it is uneven and often industry-specific. It is not a broad-based collapse.
Translate that for the listener.
Sure. If you run a business that is cost-sensitive and demand-sensitive, you are feeling both ends. But if you sell essentials or operate with long-term contracts, you are less exposed. That means the market will reward management quality and business model durability.
This is where you always come back to homework and management quality.
I have to, in a shaky environment. The best managers preserve cash flow, adjust cost structures, and communicate clearly. That reduces downside. And in my framework, those are the stalwarts and some cyclicals with strong balance sheets. I am cautious on turnarounds when the macro is uncertain unless there is a clear, company-specific catalyst.
Let me push back. Some listeners might say, that sounds too defensive. Are you missing upside?
Possibly, and that is a real trade-off. But I'd rather be a little late to a new risk on move than early to a drawdown. Also, defensive doesn't mean no growth. There are fast growers with pricing power and sticky demand that can still fit a GARP profile.
Give us a way to identify that without stock picks.
Think about subscription models, mission-critical software, or healthcare services where customers can't easily cancel. You are looking for stability of demand plus reasonable valuation. When the earnings line is consistent and the stock has been more volatile, that gap can be worth studying.
Okay, so story 2 is essentially growth may slow, but the market is distinguishing between resilience and fragility. That is what we saw in rotation.
Exactly. The rotation is the market's way of saying, I am not ignoring the risks, but I am not pricing Armageddon.
Let's do rapid fire on the remaining stories, short, sharp, and what it means. The oil shock building narrative takeaway.
It is a warning, not a conclusion. It tells you to watch duration. If disruptions last longer, costs stay elevated, and the market will reprice risk. For now, it is a risk premium, not a full reset.
The reports of global equities selling off, especially in Asia, where energy exposure is higher.
That is logical. Regions more dependent on Middle East energy face greater vulnerability. It is a reminder to diversify across geographies and not assume all markets respond the same way to a shock.
The idea that this could trigger a domino effect beyond oil and gas.
It is a fair scenario, but it is not a base case yet. For investors, that means tracking how quickly higher energy costs feed into producer prices and consumer prices. The second-order impacts are what will change earnings expectations.
Stories about a sell-off midweek as oil jumped.
That is the market doing what it does, repricing in real time, then stabilizing as probabilities get updated. If volatility stays contained, it suggests investors still see this as manageable.
And the chatter that Europe would start the week lower due to the conflict.
That is a near-term sentiment hit. The longer-term question is how European companies manage energy dependence. If they can hedge or source alternatives, the impact is mitigated.
You said earlier that you want to wait for confirmation. What are those confirming signals?
For me, it is corporate commentary on costs and demand. I want to hear whether companies are seeing sustained order weakness or if it is just a pause. I also want to see how quickly supply chains adjust.
That is a good bridge to your homework approach. Do you use Scuttlebutt here, or is this mostly public info?
Light Scuttlebutt, but only to support what companies say. For example, conversations with procurement teams can align with management commentary about lead times and pricing. It is not replacing public data. It is just extra context.
That is a helpful distinction. Let's move to the prediction scorecard. Last week, we said the market would stay selective and the biggest moves would come from sector rotation, not a broad rally. That looked right. We also expected energy to catch bids on any escalation risk. That did play out. Where did we miss?
We were a bit too cautious on the degree of market calm. I expected more volatility given the headlines. Instead, the market kept a steadier tone than I anticipated. That is a good reminder that markets can price headline risk quickly and then move on.
I'll own that too. I anticipated more defensive breadth. It was more balanced. That is useful feedback.
It is. It tells us that investors aren't rushing to shelter. They're rebalancing.
Let's get to key lessons. I want 2 or 3 that listeners can take into their weekend. I'll start. Lesson 1 is that in a risk-heavy week, the market doesn't always panic. It can rotate, it can discriminate, it can stay calm.
That is well put. Lesson 2. Duration matters more than drama. The headlines can be intense, but valuation changes when the impact looks prolonged. Watch for sustained supply disruptions rather than the initial shock.
And lesson 3.
In uncertain macro conditions, management quality is a hidden asset. Companies that communicate clearly and manage costs can defend their earnings line even when the top line is under pressure.
This is where the memory sentence goes. If you take away one thing from this week, headline screamed chaos, the tape whispered rotation.
That is the week in a sentence.
Before we close, next week's watch list, 3 specific items listeners can observe. Keep it practical.
First, watch corporate commentary on input costs. If more companies mention sustained pressure, that is meaningful. Second, keep an eye on shipping and logistics chatter. If delays increase, that can hit inventories and margins. Third, listen for changes in consumer tone. Are companies talking about pushback on price hikes or stable demand?
That is actionable. And I'll add one more question. Does the market keep treating this as headline risk, or does it start to price a more durable shock that will show up in sector leadership?
Exactly. The market's tone will tell you whether this stays a rotation story or becomes a bigger risk-off move.
Patrick, thank you. This was nuanced and calm in a noisy week. I appreciate it.
Always a pleasure, Mandy. The goal is clarity, not alarm.
And to our listeners, thanks for spending part of your week with us. If this episode helped you cut through the noise, share it with a friend. This is Capital Sound's Weekly Wrap. I am Mandy Prince. Be steady, stay curious, and we'll meet again next week. End of scripts.